and the face value of bill is given rupees 100. So now the question is, what is the yield of the treasury bill? Options are 9.65%, 9.86%, 10.39% and 10.65%. So friends, first of all understand the question. First remember that treasury bill are short-term government security. They are issued at a discount and they are redeemed at the face value. So you earn money by buying low and getting rupees 100 at the end. So you earn money by buying low and you get rupees 100 at the end. Right. So there is a formula that we use to calculate the yield. And what is that formula? Yield is equal to 100 minus P upon P, the face value. Right. So remember, for treasury bill, rupees 100 is the face value always. Now P is the purchase price. What is P? P stands for the purchase price. Okay. Then comes D. What is D? D stands for the tenure of the bond. And in this case, as you can see, the tenure of the bond is 91 days. As you can see here, tenure is how much? 91 days. Okay. So now this is the formula which will be used. So it is just substitute the value. So 100 minus purchase price. What is purchase price? It is, the purchase price is 97.50, as you can see written here. Discounted price means purchase price. So 100 minus 97.50 divided by 97.50 multiplied by 365 by 91 into 100. So this formula you have to apply. So it will give us 2.50 upon 97.50 multiplied by 4.010989 and multiplied by 100. So ultimately it will give you 10.39%. So option number C is the correct one. Right. So I hope I request you to please remember this formula. Sometime what happen? They give you the price and they ask you the yield, and sometimes they give you the yield and ask you the price. So both way you can find the concern. So what we learn from this question is that treasury bill are short-term loan you give to the government, and you buy them at cheaper rate. Like in this case, you have bought them at 97.50 rate, right? And you will get rupees 100 later. So this difference between these two number is your profit. The difference between 100 and 97.50 is your profit. And if you want to find the annual return, what is the meaning of yield? Yield just means annual return. So if you want to find the annual return, you can use the formula y is equal to 100 minus P upon P into 365 upon D into 100. So after putting the value, the answer is 10.39%. So the next time you get a treasury bill MCQ, don't panic. Just plug the value into the formula and solve the step by step. Now friends, have a look at the next question. Next question is, which of the following is not included in the computation of NDTL for CRR and SLR purpose? Right. So there are 4 options which has been given. So friends, options are interest accrued on deposit, borrowing from RBI and refinance from NABARD, Exim, etc., credit balance in the current account, liability arising from the interest-free court receiver deposit. So these are the options. So not included in the computation of NDTL. That is what it is asked. So first of all, let's go through the option number A. That is the interest accrued on the deposit. This means that interest that is yet to be paid but already due on saving or fixed deposit. So what is the meaning of interest accrued? Interest yet to be paid. But this particular interest, it is already due. It is already due on saving and fixed deposit. So even though the customer has not withdrawn it, the bank owes it. So it is a kind of liability. And yes, it is included in the NDTL as other demand and time liability. Yes, in the section other demand and time liability, other DTL, this particular interest accrued is included. Right. Please remember. For example, let me give you one example to make it more clear. For example, suppose your FD earn rupees 500 interest. So, okay. So by quarter end your FD earn rupees 500 interest. Right. So the bank has to pay you. So it is recorded as a kind of liability. Fine. Now let's look at option number B. That is borrowing from RBI and refinance from NABARD, Exim, etc. So this is the correct answer because it is not included in NDTL. It is not included in the NDTL. Why? Because these are the kind of loans that bank take from another institutions like RBI, like NABARD, these are kind of loan that bank take from RBI, NABARD, Exim Bank. But remember, NDTL include liability to the public and other bank. Try to understand what I'm telling you, that this particular NDTL, it includes what? Liability to the public, right? Liability to the public and other bank, not from the institution like RBI. Yes, these are loans from RBI, NABARD, Exim Bank, but NDTL does not include such kind of loan. NDTL basically include liability to the public and other bank. So this is excluded. You can think of it like this. If I borrow from my boss, that is RBI, it is not a general liability to the public or other bank. So it is stay out of NDTL. Then comes option number C. What is option number C? Option number C is credit balance in current account, right? So these are balance other bank keep with us. It is like one bank depositing money in another bank current account. So these are called liabilities to the banking system. Yes, it is a kind of liabilities to the banking system, and yes, they are included in NDTL. Even though it is not the public money, yes, it is still a liability. So bank adjust it with asset held in another bank and take the net value while calculating the NDTL. What bank do? Bank adjust it, right, with the asset held in the other bank. Obviously, a bank A will have some asset held in the bank B. So adjustment is done, and that is why this particular thing is excluded, right, while calculating NDTL. Means that in short we can say it is included after netting off. Yes, after netting off we include it. Option number D say liabilities arising from interest free court receiver deposit. See, this is a kind of a special case. This is a kind of a special case. These are, court ordered deposit. Like when a case is pending. Suppose a particular case is pending, right? Like when a case is pending and the money is kept with a bank interest free. So case is pending, money is kept with the bank interest free. Since it is not money that bank can freely use, it is not considered a regular liability. So it is excluded from the NDTL. Because it is not the money that bank can freely use. Okay. So it is excluded from NDTL. But wait, this is the tricky part. Although it is excluded, the question asks for what is not included. And option B is a better match because it is clearly and completely excluded. So the final answer is option number B. Right. So let's summarize what we have learned in this particular question, that what is NDTL? I told you NDTL means how much money bank owe to the public and other bank in form of saving, current and fixed deposit. So in short, if we talk about NDTL, is how much money the bank owe to the public, right? How much money bank owe to the public, that is called NDTL, right? In the form of saving account, in the form of current account, in the form of fixed deposit account. So basically this NDTL help RBI decide how much money bank must keep as CRR as well as the SLR. And what are included in NDTL? Remember it, very very important. So first of all, I told you interest accrued, that means interest payable on deposit. Yes, it is included. Then current account balance of other bank, right? This is included. But what is excluded? Borrowing from RBI, borrowing from NABARD, borrowing from Exim Bank. These are excluded. And there are some special cases like court receiver fund. These are excluded, right? Hope that this breakdown make it super clear. Friend, if you are looking for a study material for CTP, that is Certified Treasury Professional course, in the form of PDF, in the form of unit-wise MCQs, in the form of previous year question, you can enroll in our course. The detail of the course is provided in the description section. Many aspirants have cracked the examination by going through the course. You can also easily crack the examination. For more detail, you can WhatsApp me on this particular number. Now friends, have a look at the question number 3. So the question number 3 is on your screen. It is also one numerical based question, very very important from examination point of view. Have a look. So friends, what is the question? You are analyzing a 3-year corporate bond with face value of 100 rupees, offering annual coupon rate of 12%, prevailing YTM is 8%, bond is trading as 110.50. What is Macaulay duration in year of the given bond? Yes. So what is in simple term, when we talk about this Macaulay duration, it simply means average time it takes to recover the bond price from its cash flow. I'm again repeating, average time it takes to recover the bond price. How much time it takes to recover the bond price from its cash flow, right? So that is called Macaulay duration. So basically it consider both the timing, it consider both the size of each payment. Yes, timing is also considered and size is also considered. Now, as you can see here, that this particular bond is paid semi-annually. You can see this word written here, semi-annually, right? So what is the meaning of this term semi-annually? You know it very well. Twice a year, right? So basically, since this bond pays semi-annual coupon, that means 2 payment per year for 3 years. So can you tell me how many period will be there? See, in every year, 2 period, right? So total is a 3 year. So it will be 6 period in total, right? Total it will be 6 period. Now, let's calculate step by step. First of all, calculate the coupon amount. What is the coupon per period? What is the coupon amount per period? As you can see, it is 6%, I think. No, it is 12% annual. So semi-annual it will be 6%. Okay, so 6% coupon of the face value. What is face value? 100 rupees. What is 6% of 100 rupees? It is rupees 6. Right, because 12 rupees it paid every year, but every half year, our period is half year. So every half year, you can see YTM is given 8%, but this 8% is annual. So what will be the YTM for 6 months? It will be 8 by 2, which is equal to 4%. Now have a look at the cash flow. So for cash flow, what we will do? We will create a particular table. This tabular method is the most preferred one for computing this, McLeod duration. So first we will write period. Then we will write the cash flow, then we will write PV at the rate 4%, and then we will write PV multiplied by TI. Okay, PV multiplied by time. Now, so basically these are the columns that we have: period, cash flow, PV means present value at the rate 4%. Now, so we have 6 period. 1, let me write down, 2, this is 3rd, this is 4th, this is 5, and this is 6. Okay. Now, what are the cash flow? Coupon amount 6 rupees, 6 rupees, 6 rupees, 6 rupees, 6 rupees, and finally you will receive 6 rupees along with the face value, which is equal to 106. So these are the cash flow. Now we want to calculate this is present value factor, right? So what is the present value? How to calculate the present value? So basically to calculate the present value, how do we do it? So future value upon 1 plus r whole to the power n. So for the first case we will write n is equal to 1. So it is nothing but 6 divided by 1 plus 0.04, which is equal to 5.77. In the second case it is equal to 6 divided by 1.04 chi square, right, which is equal to 5.55. In the third case 6 divided by 1.04 ka cube, which is equal to 5.34. 6 divided by 1.04 to the power 4, which is equal to 5.13. 6 divided by 1.04 to the power 5, which is equal to 4.93. And finally, in the last case, 106 divided by 1.04 to the power 6, which is equal to 83.78. Right. So these are the present value. Now in the last column, what we will do? We will multiply the present value with the time. So what is the time? This period I am talking about. So first of all, in the first row, it will be 5.77 multiplied by 1, right? Which is equal to how much? 5.77. In the second row, it will be 5.55, this one, multiplied by this one. Okay, so this will give us how much? This will give us 11.10. In the third row, this will be 5.34 multiplied by 3, which will give us 16.02. Similarly, 5.13 multiplied by 4, which is equal to 20.52. 4.93 multiplied by 5, which is equal to 24.65. And finally, 83.78 multiplied by 6, which is equal to 502.68. So now as you can see, total present value, if you add all this value, 5.55, 5.34, 5.13, if you add all of this, you will get how much? You will get total present value as 110.50. This is the total present value, or we call it summation of PV. And if we calculate summation of PV into T, so this will give us, if you add all of them, you will get how much? 580.74. Now let's apply these two in the McLeod duration formula. So what will be the McLeod duration? Summation of PV into T upon summation of PV, which is equal to 580.74 upon 110.50. Okay, so the answer will be how much? 2.63. This will be the McLeod duration. So option number B will be correct. 2.63 will be correct. Right. I hope that makes sense to you. Now let's summarize the point we have covered in this particular slide, what I told you, that Macleod duration is a kind of, average time, right? This is a kind of average time to recover the bond price. You have to recover the bond price. Average time it takes to recover the bond price is called Macleod duration. And it uses present value of each cash flow multiplied by time. Semi-annual coupon bond means you have more frequent payment, reducing the duration. And always remember, always divide PV into time by the price. Okay. So if the payment are semi-annual, convert period into year at the end. Right. So I hope that makes sense. I have explained each and every option, each and every step, how to go about calculating the duration. Now friend, let's look at the second part of this particular question. The question is, if yield increases, what happened to the bond duration? Very good question. Duration increase, duration decrease, duration remain unchanged, and duration become 0. First of all, let's understand what is the meaning of this duration in the simple word. I told you now that duration is the kind of average time. Average time it takes for a bond holder. Suppose there is a bond holder, how much time it will take for a bond holder to recover the money? Because bond holder have invested the money, right? So how much time it will take to recover the money, right, that they have invested in the bond? So it is not just about time. It's also about, value of future payment. It's also about value of what? Future payment. It is not just about time. Now the question is, what happened when the yield increase? As you can see, yield is increasing. The question is, what will happen when the yield increase? So as you can see, if yield will increase, then discount rate will decrease. And what will happen if discount rate will decrease? What will happen? Those future payment will get discounted more heavily. They get discounted heavily. The future payment will get discounted heavily. That means, for further payment lose more value compared to the nearer one. So it simply means, further payment will lose value instead of the compared to the nearer one. So the weight shift toward earlier payment. Weight shift toward earlier payment, right? And since weight shift toward earlier payment, so what happened? Your duration becomes short, right? Your duration becomes short or duration decreases, right? Let's go through each and every option. Option number is a duration increase. Wrong. It is wrong. Why? Because if the yield increase, future cash flow are worth less today. Duration actually fall because we recover value faster. Because as you can see, yield increasing, discount rate decreasing, future payment get discounted heavily, further payment lose value, weight shift toward earlier payment, and duration decreases. Now option number B say duration decrease. Exactly. Because higher yield means lower present value of the long-term payment, shorter average time to recover payment, and duration goes down. Let me give you one example to make it more clear. Suppose you lend rupees 100 and you expect rupees 50 next year. You expect rupees 50 next year. You have lent rupees 100 and you expect rupees 50 next year, and rupees 50 you are expecting after 5 years. In the next year you are expecting 50 rupees and 50 rupees you are expecting after 5 years. Now in this case, suppose interest rate increases. So what will happen? That 50 rupees in the 5 year is worth much less now. So most of your value is recovered today. So obviously your duration will get lower. Why it is worthless? Because if you calculate the present value, it is future value upon 1 plus r whole to the power n, right? So if interest rate is increasing, this one is increasing, so this is decreasing, so present value is decreasing, so the worth of this 50 rupees is very less. So what happened? The duration shift toward the earlier value. That's why the duration of the bond decreases. Means you can recover the amount early, right? So that's why option number B is the correct answer here. Whatever, which of the following correctly describe its formula? So 4 formula are given here. Option A is portfolio return minus market return divided by beta. Option B is portfolio return minus risk-free return divided by standard deviation of the portfolio return. Option C is portfolio return minus risk-free rate multiplied by standard deviation of the portfolio return. Option D is portfolio return minus benchmark return divided by standard deviation of the benchmark return. So these are the 4 options. So friends, you can think of the Sharpe ratio as a way to measure how much return you are earning for every unit of risk, right? For every unit of risk, right? How much return you are earning. That is called Sharpe ratio. Basically, it compare your portfolio return to risk-free investment. So what are risk-free investment? What are the example of risk-free investment? So like, government bond. Government bond is a kind of risk-free investment. So basically what you do, it compare, on one side you have your portfolio return and the other side you have your risk-free investment. Okay, so both comparison is being done, portfolio return versus risk-free investment. And then after comparing, it divide it by how much your portfolio fluctuate. That is called a standard deviation. So now the formula for Sharpe ratio is very simple. You write the return, subtract it with the risk-free rate, and you divide it by the standard deviation of return. You divide it by the standard deviation of the return. So basically you are getting extra return per unit of total risk. So let's break down each and every option. First of all, let's look at option number A. It says portfolio return minus market rate divided by beta. It is wrong formula because this is actually for trainer ratio. This formula is actually for trainer ratio, not Sharpe ratio. It use beta. Trainer use beta, which only consider market risk, but Sharpe use total risk. What about option B? Option B say portfolio return minus risk-free rate divided by standard deviation of the portfolio return. Yes, it is the perfect formula. Because this is the exact formula for the Sharpe ratio, you take the extra return over safe investment and divide it by the volatility of the portfolio. Right? So what you do here, that you take the extra return over the safe investment. So this is your safe investment and this is the extra return you are getting. You take the extra, means you define the difference. So this is the extra value. Right? And you divide the extra return by the volatility of the portfolio, and volatility is measured by the standard deviation. So suppose, let me give you one example. Suppose your portfolio give 10% and suppose risk-free rate is 5%. Okay, and the standard deviation is suppose 2%. So what is the Sharpe ratio? Sharpe ratio is 10%, which is your return. 10% is your return. Then you subtract risk-free rate, which is 5%. 10% minus 5%. And you divide it by the standard deviation, which is 2%. So which is equal to 2.5. So which means 2.5 unit of return per unit of risk. So basically in the numerator we have return only. In the denominator we have, risk. Right. So basically 2.5 unit of return per unit of risk. So this is the option. Option number B is the correct answer. What about option C? This they have multiplied it. Instead of dividing, they have multiplied. So it is quite incorrect. Option D is also incorrect. So what we learned from this discussion is that, this particular Sharpe ratio, it tells you how efficiently your investment give return for the risk you are taking. Means how efficiently your investment is giving return for the risk you are taking. It uses risk-free rate, okay, as baseline. It measures the total risk. It measures the total risk using the standard deviation. How do we calculate it? We write the portfolio return. We subtract the risk-free rate and we divide it by the standard deviation of the portfolio. Right? So this will give us the Sharpe ratio. So remember, if the question asks about Sharpe, you always look for risk-free rate and standard deviation. If you see beta, that is basically for, trainer ratio. Now friends, have a look at the next question. So the next question is another based on commercial paper CP. So question is, ABC Limited and reputed Indian corporate with net worth of 200 crore. They plan to raise short-term working capital via the issue of commercial paper. Okay. The company already has a standard fund-based facility from a leading public sector bank. ABC Limited has a credit rating of A3 and they want to issue CP worth 10 crore with maturity of 90 days in demat form. They appoint a scheduled bank as the issuing and paying agent, that is IPA. After 40 days, ABC Limited wishes to buy back the CP from the investor. So basically every aspect has been taken care of in this particular scenario. Right. So basically they have a net worth of 200 crore. Right. They want to raise money via CP. And they have a standard credit rating of A3. They want to issue CP worth 10 crore. Maturity 90 days. Demat form. Okay. They have appointed IPA. After 40 days they wish to buy back the CP. Now the question is, which are the following conditions make ABC Limited eligible to use CP? Option A, net worth of 50 crore and a bank loan under default. Option B, net worth of 200 crore and a standard fund based facility. Option C, credit rating below A3. Option D, no working capital sanction from any bank. So basically, if we talk about this CP, which is a commercial paper, so commercial paper is short-term IOU. It is a kind of short-term IOU. Basically, who issue it? Company issue it, right? To borrow money. Why company issue it? Company issue it to borrow money for a few months, usually up to 1 year. Usually up to 1 year without giving a collateral. But because it is unsecured, yes, it is unsecured. Because it is unsecured, only company with a strong financial can issue it. There are some eligibility criteria. So minimum credit rating is A3, right, or better. Minimum credit rating is A3 or better. And first point. Second point is they must have a standard fund-based facility. This is very much required. A standard fund-based facility, right? It is required from a bank. And the third point is, suppose it is corporate, suppose it is LLP, or suppose it is a trust, corporate, LLP or trust. So net worth must be 100 crore or more. So these are the three conditions which make ABC Limited eligible to issue CP. First of all, credit rating of A3 or more. Second point, standard non-default fund-based facility from a bank. And for corporate, LLP and trust, net worth must be 100 crore or more. So let's look at the option. Option is a net worth of 50 crore. No, RBI require minimum 100 crore as net worth. 50 crore is too low. And if the bank loan is under default, the company is clearly not financially healthy. What about option B? Net worth of 200 crore and standard fund-based facility. It is perfect because ABC Limited has 200 crore net worth, a standard bank facility, credit rating of A3. So all eligibility box are ticked. So yes, this is a criteria. Credit rating below A3, they are ineligible because A3 is the minimum accepting criteria. A3 is the minimum accepted criteria. Anything below A3 like B or C, it means high risk. And then we have option D, no working capital sanction from any bank. This means company has no verified credit track record. Company has no verified credit track record. So RBI want company to have an existing fund-based limit. It shows the bank has checked them, so this condition also failed. So let's summarize the point. First of all, what we talked about is the CP is a kind of short-term borrowing tool for financially sound company. And I told you the eligibility rule. The first one is that its net worth must be greater than or equal to 100 crore. Second point is that its credit rating must be more than A3. Third point is that it should have a standard bank fund-based facility. It should have a standard fund-based facility. Okay, so remember, if a company want to issue CP, it must be financially strong, not just big. Now friends, have a look at the next question. So the next question is, this question is also related to the same case study. It is asking you, what is the minimum maturity and the form of issuance required for ABC Limited CP? CP means commercial paper. Option A 30 days physical certificate, 15 days demat form, 7 days demat form, 1 day physical certificate. So I told you this CP is a commercial paper. It is a kind of short-term borrowing tool used by company to raise money quickly. It is usually used for working capital need. And it is unsecured. It is quite unsecured, meaning no collateral, and it is issued at a discount for a fixed maturity. And as per RBI guideline, the minimum maturity for CP is 7 days, and the maximum maturity is 1 year, right? So, and one more thing is that CP is issued in demat form. CP is issued in demat form. Demat means electronic form, especially since bank can only invest in demat CP. Now let's look at the option. Option A says that 30 days physical certificate. So 30 days within the allowed range, but there is a problem that physical certificate are not the norm anymore, right? CP are issued in demat form only. Option B say 15 days and demat form. Yes, it is correct. Demat form is correct, but minimum maturity should be 7 days, not 15 days, right? So option C, yes, option B is also not the correct one because demat form is correct. Option C is 7 and demat form. Yes, this is the absolutely correct answer. This is the perfect answer. Minimum maturity, just told you 7 days, and demat form, yes, this is very much important. So what we learned from this discussion is that commercial paper is a short-term money tool for a company. Minimum maturity, I told you, it is just 7 days, and it is issued in demat form only, right? Bank can invest in CP only in demat form. So the final answer is option number C. Now friends, have a look at another question based on the same discussion. ABC Limited buy back the CP 40 days after issuance. which of the following is true? Option A, that this buyback is allowed as minimum 30 days have passed. Option B, buyback is invalid as CP cannot be repurchased. Option C, buyback must be done at face value only. Option D, buyback must be done on 90th date only. So tell me, so ABC Limited buyback the CP 40 days after issuance. So which one is correct? Let's first understand, can a company buy back it on CP? This is the question. Can you buy back on CP? Can you buy back on CP? See, the answer is yes. Yes, company can buy back their own commercial paper before maturity, but only under certain condition. The condition is that the commercial paper must be at least 30 days old. The commercial paper must be at least 30 days old, right? And the buyback should happen through the secondary market. This is another condition, that buyback should happen through secondary market, not privately. It should not happen privately. So these two conditions must be fulfilled. First one I told you, it should be 30 days old. CP must be at least 30 days old. And the second condition is that buyback must happen through the secondary market. It should not happen through privately. Now, as per the RBI rule, you must remember that buyback of CP is allowed through secondary market only. First point, it must be done after 30 days from the issue date. And you know, it is always done at the market price. It is always done as the market price, not necessarily at the face value. Now, in this case, what we are observing is that CP was issued for 90 days, right? CP was issued for 90 days. As you can see in this particular question, let me come back to this particular question. Let me show you that here you can see that CP was issued for 90 days. As you can see, maturity is 90 days. And ABC Limited want to buy back on day 40. Yes, ABC Limited want to buy back the CP from investor on day 40. Since 40 is larger than 30, so the buyback is valid. Because I told you, na, minimum 30 days, right? It must be done after 30 days from the issue date. After 30 days. And yes, it is being done after 40 days. So obviously it is valid. Before 30 days, it is not valid. Now, in this case, CP was issued for 90 days. ABC Limited want to buy it back on day 40. So obviously, let's go through each and every option. So option number A say, the buyback is allowed at the minimum 30 days have passed. Yes, this is correct. As per RBI guideline, buyback is only allowed after 30 days. Since 40 days have passed, this is absolutely valid. What about option B? Buyback is invalid as CP cannot be repurchased. What do you think about it? See, this is wrong. Why it is wrong? Because CP can be bought back, but through the secondary market and only after 30 days. So this statement is not correct because it is saying that buyback is invalid. No. Buyback is not invalid. Rather, it can be bought back. Option C say buyback must be done at the face value only. Totally wrong. Because CP is traded in it is talking about face value. See, you know, CP, they are traded in the secondary market. They are traded in the secondary market, right? And the price constantly fluctuate. So buyback always happen at the market price. Remember, buyback always happen at the market price, not face value. Then option number D say buyback must be done on the 90th day only. This is also wrong. Totally wrong. Because CP is mature on the 90th day, but company are allowed to buy it back before, as long as 30 days have passed. So the day 40 is fine. So let's summarize what we learned from this particular question, because learning is very much essential. I told you that CP can be bought back by the issuing company. Yes, issuing company can buy back the CP. This is the first point I told you. Second point I told you that buyback must happen after 30 days. Third point I told you, the buyback is done through the secondary market. Remember, buyback is done through the secondary market and it is done at the market price. So someone asks you whether buyback is possible at the face value. No, remember, buyback is not possible at the face value. And the fourth point is I told you, no need to wait until maturity. No need to wait till maturity. You did not wait till maturity, right? So I told you in this particular case, since 40 days have passed, so buyback is allowed. So the key takeaway is that the buyback of CP is allowed, but not too early. Wait 30 days and then go to the market. Simple. I hope that makes sense, right? Now the last question of this particular case study is that, as you can see, why might a bank choose to invest in ABC Bank CP? Option A, CP has high credit rating but long-term maturity. CP is risk-free and interest-free. CP offer higher yield than interbank money market with short-term credit exposure. Option D, CP is a physical security with high liquidity. Now the very good question it is. Let's first understand what is CP. I told you it is a kind of short-term debt instrument issued by company to raise money quickly. And why bank prefer CP? Because it offer better return. CP, you know, CP offer you better return. It offer you better yield as compared to call money, as compared to overnight lending. So if you compare to call money, if you compare to overnight lending, this CP is offer better yield, and the credit risk is short term. Yes, the credit risk of this CP is very short term. Okay, and it is a kind of tradable instrument. So there is a good liquidity. Let's go through each and every option. If you go through the option number A, it says that CP has high credit risk but long-term maturity. It is completely wrong. Why? Because CP actually has low to moderate credit risk, and it is a kind of short-term instrument. It is usually 7 to 365 days. So this statement is incorrect. Option B say it is risk-free and interest-free. It is again wrong. CP is not risk-free. Though it is issued by top-rated company, there is still some credit risk. Also, it is not interest-free. It is issued at discount and redeemed at face value. So investor earn interest indirectly. Option C say it offer higher yield than interbank money market with short-term credit exposure. Try to understand. CP usually give better return than call money or interbank lending. And since CP mature in a few week or month, the credit exposure is short-term, which reduces the risk. Let me give you one example. For example, suppose that interbank call money rate. Suppose interbank call money rate is 5%, and suppose CP is offering you 6.5%. So the bank earn more, right? So the bank is earning more. Bank is earning more by investing in CP with only 90 days exposure. And option D say CP is physical security with high liquidity. This is partially wrong. Yes, CP has high liquidity, but it is not a physical certificate anymore. I told you already, it is always issued in the form of demat form. So let's summarize the point which we have just covered. First of all, why bank invest in CP? Because it offers higher yield than short-term bank-to-bank lending. And credit risk is low, right? And it is only for short time, limited to short period. And CP are quite tradable, right? So bank can sell them before maturity if needed. And CP is always issued in, demat form. So option C is the correct answer. Now friends, have a look at this question. From bond, many questions they are asking, right? In this question, they have provided you the data like, face value they have given 1,000 rupees. Coupon rate they have given 12%, and it is paid semi-annually. And 3-year maturity is there, right? And the required rate of return is 10%. So they have asked you to calculate the value of the bond. So friends, how to calculate the value of the bond? First of all, what is the face value? Face value of 1,000. What is the coupon rate? Coupon rate is 12% annually. So which means 6% every 6 months or every bi-yearly. So what will be the coupon payment? If you calculate the coupon, it will be 1,000 multiplied by 6%. Okay, that will be how much? 60 rupees every 6 months. Now what is the maturity? If you look at the maturity, I think it is 6 year, but it is 3 years, sorry. It is 3 year. So it is 3 year. How many periods are there? 3 multiplied by 2. So there are 6 periods. Okay, 6 half-year period. And what is the required rate of return? What is required ROR? So required ROR, as you can see, is 10%. Required ROR is 10%, and that is per annum. And we want to calculate it after 6 months. So it will be 5% every 6 months. So everything you have to compute 6 month basis. Now we will use the present value formula. So bond value it can be categorized into 2 parts. First of all, what do? You calculate the present value of coupon payment, all coupon payment, plus that is called annuity. So in that case, you apply the annuity formula to calculate the present value of all the coupon payment, and then you calculate the present value of the final principal amount. You calculate the present value of the final principal amount. That is called lump sum. That is called lump sum. So now in the question, they will provide you present value interest rate factor. So let me give you, so they will give you PVIFA. That is called, present value interest rate factor. Please remember. So PVIFA 5% for 6 month coupon is, they have given you 5.074. This data will be given in the question. Don't worry about that. And PVIFA for 5% interest at 6% at 6 month coupon, they have given you. Try to understand. This is PVIF. present value interest rate factor and present value interest rate factor annuity. So these are two different. So they are given you 0.746. Now this data is available. So what we will do to calculate so we will calculate separately. Let's calculate the present value of coupon. How do we do that? So multiply this 60 rupees with 5.0746. Okay. So with the PVIFA, how much you will get? So you will get 304.48. 304.48. So this is the PV value of the coupon. And what is the PV value of the principal? What is the PV value of the principal? So that is nothing but 1000 rupees multiplied by 0.746, which is nothing but 746 rupees. So the total value of the bond, total value will be the sum of these two, which is 304.48 plus 746. And if we add both of them, we will get 1050.48. Right. If you go through the option, so nearest option is option number B, and yes, it is the correct answer. So friends, remember, let's summarize what we learned from this question. You know that bond pay rupees 60 every 6 months for 3 years. What we do, we discount those cash flow using the required return. And what is the required return? Required return is 5% per period. We add the present value of all the coupon payment and we add the present value of the face value. And we use this PVIFA and use this PVIF from the standard table. There is a standard table and in the examination they provide you the data. And remember, if the coupon rate is larger than the required rate, so bond always trade above par. And you can see bond is trading at 1050 rupees. So remember, if the coupon is more than the required rate, the bond price goes above rupees 10,000. Right. So friends, I hope this concept is clear now. Now friends, if you really think that this video is adding values to your preparation, please hit that like button. This will encourage me to make more such and such content. Right. Now friends, have a look at the next question. The next question that we have is related to Mr. Raj. Mr. Raj is a corporate treasurer. He is managing a 10 crore floating rate loan, right, which is linked to 6-month LIBOR. He is concerned that interest rate may rise above 7%, which could increase his interest expense significantly. Right. So he feared that interest rate may rise above 7%. So what he did, he buy a interest rate, cap with a strike rate of 7%. One of his settlement period sold LIBOR at, so the LIBOR at 8.5%. Okay. Now as you can see, one of the settlement periods so the LIBOR at 8.5%. Now the question is, what is the main purpose of the Mr. Raj buying an interest rate cap? Option A, to benefit from falling interest rate. Option B, to protect against interest rate falling below 7%. Option C, to reduce loan principal. Option D, to hedge against the rising interest rate above 7%. This is a very good question. Now the question is, what is the meaning of this interest rate cap? See, this is like, insurance policy. This is like, insurance policy for whom? This is insurance policy for borrower. Right. It set a maximum limit, and that maximum limit we call the strike rate. That maximum limit we call the strike rate on how much interest they have to pay on a floating rate loan. So they set a maximum limit on how much interest they have to pay on the floating rate loan. In this case, as you can see, Mr. Raj, he has 10 crore loan. Mr. Raj has 10 crore loan. It is linked to 6-month LIBOR. It is linked to 6-month LIBOR. And suppose LIBOR rises above 7%. If LIBOR rises above 7%, so the cap kicks in. Cap kicks in. Right, because they have set the cap at how much? They have, as you can see, they have set the cap at 7%. Yes. So if the LIBOR increases 7%, cap will kick in. Right. So he will only pay up to 7%, and the difference, suppose the rate as you can see is 8.5%. So what is the difference? 8.5 minus 7%, which is how much? 1.5%. So this 1.5% is paid by the cap seller. This will be paid by the cap seller. Right. So that is the point. Now let's go through each and every option. Option A, to benefit from falling interest rate. See, cap don't help with the falling interest rate. See, if the interest rate fall, right, Raj pay lower interest anyway. That is the benefit of a floating rate loan. The cap only have help when the interest rate rise. Option B, to protect against interest rate falling below 7%. This is again wrong. That sound more like a floor, not a cap. Cap help when the rate go above a certain level. Floor help protect the minimum interest income, which is not the case here. To reduce loan principal. Again, it is completely incorrect. Interest rate cap has nothing to do with principal. They only manage the interest payment risk. Option D say to hedge against rising interest rate above 7%. Yes, this is the perfect. That is exactly why Raj bought the cap. He is afraid that LIBOR will go above 7%, which means higher interest outflow. So the cap makes sure that his cost does not rise beyond 7%, no matter what LIBOR does. So let's summarize what we come to know in this particular question. So friends, I told you that we talked about interest rate cap. It is a kind of ceiling. Let's summarize. Interest rate cap is a kind of ceiling on how a high interest rate payment can goes up. In the case of Mr. Raj, you can see he has a floating rate loan. Interest rate move with the LIBOR. He want to avoid paying more than 7%. So he buy a cap at 7%. If the LIBOR go to 8.5%, he still pay only 7% and the cap seller pay the rest. Now, the question is, how much Mr. Raj received from the cap in the settlement period when LIBOR rises to 8.5%? Very good question. Right. So friends, let's understand the concept first. When LIBOR rises above the cap rate, and the cap rate is how much? 7%. Right. So Mr. Raj get a payout from the cap seller. Yes, he will get a payout from the cap seller. This compensate him for the extra interest he would otherwise have to pay on his loan. And if you want to calculate the cap payment, this question is most frequently asked. Remember the formula. Just take the notional value. Just multiply it by the LIBOR minus the cap rate. Just multiply it by days and divide it by 360. Because days to convert into year, we multiply it by 360. Now let's plug in the value. What is the notional value? 10 crore. 10 crore is the notional value. What is the LIBOR rate? So LIBOR rate has risen to 8.5%. What is the cap rate? Cap rate is 7%. So this is nothing but 0.085. This is nothing but 0.07. Now let's apply the formula. So 10 crore, 10 will get 9 rupees as interest, because if you find 9% of 100, you will get 9 rupees. So this is the step number 1, means what the bond give you. So the bond give you rupees 9 as interest. Second thing is how much investor get paid. How much investor get paid. This thing you have to look upon. So you know the bond was bought at rupees. It was purchased as rupees 105. It was not purchased on rupees 100, right? The bond was bought. The bond was bought at rupees 105, right? So this is the point. Now, if we apply the current yield formula, if you remember the current yield formula, right, it is very easy to understand. So basically what you do in the case of finding the current yield or CY, you write the annual coupon in the numerator. Okay. And in the denominator, what you write? You write the purchase price. Annual coupon divided by purchase price multiplied by 100. So what is the annual coupon that you have? So annual coupon is 9 rupees. And what is the purchase price? You bought it at 105, multiplied by 100. So you tell me, 9 is how much percentage of 10.105? So that is nothing but 8.57%. So the correct answer is option number B, right? So even though, try to understand, even though the bond is paying 9 rupees per year, but the return based on what the investor actually paid, which is 105, is only 8.57%. So remember, whenever we find the current yield, we see that at what price the bond was purchased. If we don't see the face value, rather we see the market price of the bond. We compare it with the market price of the bond. That is the crux of this particular question, and we get 8.57%. Now friends, let us go through each and every option. Option A is 9.45%. This would be correct if the interest was higher or the price was lower, obviously, right? Not applicable here. 8.57% is the clear answer. So let me give you one example to make this concept more clear so that you can remember the formula for lifetime. Imagine that you buy a juice bottle. Suppose you buy a juice bottle worth rupees 100. This is the MRP. 100 is the MRP, and you buy the juice bottle, but you pay rupees 105 for it, right? You paid rupees 105. So you still get the same juice. That is 9 rupees coupon. Here juice is the coupon, right? You still get the 9 rupees coupon. but your cost is higher. So your return is bit lower than expected. So you expected obviously 9% return, but since you paid larger, so your return will be 8.57%, which is lower than the expected return. So that is what coupon yield is all about. So what we learned from this question is that, so first of all, you must understand what is coupon. Coupon is the fixed percentage on face value. Coupon is the fixed percentage on face value. This is the first point. Second point we talked about is the current yield. What is the current yield? This is the return. Current yield is the return based on purchase price. Now one more thing. If you buy above face value, right? If you buy above face value, what will happen? Your current yield will go down. As you can see, in this case, current yield go down to 8.57%. Because you buy above face value. And what is the formula for current yield? It is quite simple. In the numerator you write the coupon, in the denominator you write the price you have paid and multiply it by 100. So that is the formula for current yield. And you should ignore any kind of capital gain or capital loss or maturity value. So that is how you calculate the current yield on bond in the simplest way. I hope it is clear now. Now if any question is asked related to current yield, you can easily answer. Now friends, have a look at the second question, which is based on the treasury function. Right, I have also bifurcated the topic name for your easy understanding. You can understand that yes, this topic is super important because questions are most frequently being asked based on them. So the question is, which of the following correctly match the role of front office, middle office, back office in the treasury function? Right, so you can see options are given. Function, you should know the function of these all these office: front, middle, back. So what are their function? So have a look at the option. Option number A say front office validate and settle deal, middle office execute transaction, and back office manage funding and liquidity. B say front office handle funding, risk and liquidity management, middle office support deal validation, and back office execute market transaction. C say front office execute and analyze funding, cash and risk, middle office handle reporting and analysis, and back office validate, settle and account for deal. And D say front office handle internal audit, middle office only deal with IT infrastructure, and back office analyze trading pattern and market risk. So these are the options which has been given to you. So now friends, let's break down what each office does using a simple analogy. Okay, I will give you a simple analogy so that you can remember it for the lifetime. So first of all, let's start with the front office. So you can call them as, you know, director. Imagine a movie production. You take the example of a movie production. Okay, so suppose movie is being produced. So director and the actor, they are the front office. So they are the one in the action. Basically they are doing deal. They are doing deals. Okay, they are managing the risk. They are in action. They are doing deal. They are managing risk. They are handling the cash flow. Yes, they are handling the cash flow. So basically what they do, they make the real-time decision. Let me write it down. They make the real-time decision in the market. Who? Front office. Okay, so we are currently producing a movie. Just try to imitate it. Now, after that comes middle office. Now, who are the middle office? Middle office are the analyst and the planner. In the movie production, in terms of movie production, you can think of them analyst and the planner. They are the analyst. They are the planner. So what they do? They monitor the performance. Right? They monitor performance of each and every cast crew. Right? They check the risk. They create report. Yes, risk checking is also their part. Okay. See, here we also managing risk, but here checking the risk. Right? And then creating the report creation they have to do. Also they have to ensure that the deal made by the front office follow the rule. Whatever deal is made in the front office, they should follow the rule. So basically you can think of them as, you know, a strategy and control team. And the third team that we have is called, you know, back office. So the back office are, you know, administration team. You can call them as, you know, admin team. So they handle all the paperwork. All kind of paperwork are being handled by the back office. Any kind of confirmation that has to be given, any kind of settlement that has to be done, any kind of accounting work that has to be done, all are handled at the level of back office after the deal are done. Without them, no deal is complete. Now, I hope I have provided you the example, each and every function of each and every office. Now let's go through each and every option. First of all, if you look at the option number A, so it says that front office validate and settle deal. No, this is wrong. Front office does not handle validation and settlement. No, this is not handled by front office. That is the back office job. I told you now. Any kind of paperwork is being handled by the back office. So, and obviously middle office execute transaction. No, they don't execute transaction, and back office does not manage liquidity. So this is completely wrong. Okay, option number B. Yes, in the case of option B, handle funneling risk, and it is partially correct. Yes, front office rule is partially correct, and back office they are saying execute market transaction. No, that is wrong. Back office never execute market trade. That is a front office job. So option B is also wrong. If you go through option C, yes, this is completely correct, because you know front office, what they do, they execute and they manage risk and cash, right? That is the role of front office. In the case of middle office, I told you reporting and risk analysis is being done by the middle office, and back office they confirm and settle the deal. You can see validate, settle and account for the deal. So yes, option number C is completely correct. What about option D? In option D they say that they handle the internal audit. No, that is wrong. Front office does not do audit. You must remember that middle office is not only IT. It is written that middle office only deal with IT infrastructure. No, it is wrong. And back office does not do any kind of market analysis. That is the middle office territory. Any kind of market analysis is done by the middle office. So let me give you one real life example of it. For example, let's say a bank want to buy foreign currency for a client. So try to understand. Suppose a bank want to buy foreign currency for a client. Okay. So in this case, what will happen is front office FO, what they will do, they will talk to client. They will execute the currency trade. So trading will be executed by the front office. Executing trade. Okay. Now what middle office will do? Middle office will check if the deal is within the bank risk limit. You know, there is a risk limit of the bank. So whether the deal is within the risk limit. And what the back office will do? Back office will confirm the deal. Back office will settle the money. Settlement is done here. And accounting work is done by the back office. So this is the clear bifurcation of the role performed by all these three offices. So what we learned from this discussion is that, the learning is that, whenever you see this word front office, just remember this front office, they are the deal maker. So let me write it down. So FO, they are the deal maker. Okay. They execute the trade. Trade execution is done. They manage the risk. Okay. And they manage the liquidity also. Then we talk about the middle office. So middle office, they are the controller. They ensure that the risk which is taken are within the limits. So they report, they monitor, and they help maintain check. Okay, that is middle office. And the last is the back office. Back office are the executors. Okay, so they handle confirmation, they handle settlement, and they handle the records. So in one word, if I say, if I just summarize this thing in one word, so you can say FO, they are in action, like in the movie. MO, they are monitoring. M for monitoring, you can think of them like that. And BO, they are the administration, admin. Okay, action, monitoring and admin. Just remember this word and the entire picture will come into in your front. That is how treasury team functioning in the bank or corporate setup. Friends, if you are preparing for CTP examination and if you are looking for a study material for CTP, that is Certified Treasury Professional course, you can install our app JIB and CIB Made Simple. I have created a course in which you can see two folders are there, previous year question. I have added one previous year question part 1. I am adding more and more, and also I have separate folder for theory and MCQ PDF. If you go through this particular folder, you will see module wise content A, B, C, D, E, and inside each module, like you open module A, you will see unit wise content. And suppose you open the unit 1, you will see theory PDF and MCQ PDF. So theory PDF caters to all the important points written in the bullet format. As you can see, every point is written in the bullet format, and MCQs PDF cover the MCQs based on them. So this is a complete course on CTP, and this will help you to get a good marks in the examination of CTP. If you want to enroll in this particular course, what you can do, you can WhatsApp me on this particular number. So I am writing down the number here. So please, you can WhatsApp me and you can get detail how to access this course, or in the description section you can check out the course link. You can directly click on the course link and can access it. So this is the WhatsApp number. You can WhatsApp me on this particular number. Now friends, I hope it is clear. Now let's go to the question number 3, which is based on option risk metric, that is the Greeks. Let's try to understand. Question is, which of the following statement about Greeks in the option trading is correct? Okay. Option A says that Greek represent the different country where options are traded. B says that Greeks are used to determine the final price of option contract. C says Greeks are mathematical measures used to assess different dimension of risk in option position. And D say Greeks refers to currency fluctuation affecting option in European market. So which option do you think is correct? First of all, let's understand what is the meaning of this Greek. Basically, what happened in the case of option trading, Greeks are not people or not countries. Rather, they are just risk indicator. In one word, I will say they are risk indicator. That's it. Okay. So they help the trader understand how sensitive their option is to different factor. Yes. So basically, this is the option. How sensitive their option is to the different factor. Like, what are the factor? Like, price change. This is one factor. Like, time left. This is another factor. Like, interest rate. This is third factor. And market volatility. This is the fourth factor. So basically, these are the factor, and this Greek tell you that how sensitive their option is to different factors. Okay. Now let's go through each and every option. Option A say Greek represent country. No. That is completely incorrect. It might sound fancy, but totally wrong. Greek are not about geography and nationality. It's just a name. Option B says that Greek determine the final price. No, this is wrong. Basically, Greek tell you how much price might change when something else change. Okay. Like if stock price goes up or down. I told you that these are the factors. So how the price will change, that is what Greek tell you. Option C say they are mathematical measure used to assess the different dimension of risk in option positioning. Yes, that is absolutely correct. Because the Greek help the option trader manage the risk. One word I will say, they help the option trader manage the risk. For example, delta. Have you heard the name of delta? So this delta show how much the option price will move. This delta is a kind of Greek. It shows how much the option price will move if the stock move by 1 rupees. Suppose a stock move by 1 rupees, how much the option price will move. That is what delta tell you. Right? And another Greek is theta. Right? These are the Greeks. You must know. Delta, theta. So what theta tells you? Theta shows how much value the option lose. How much value the option lose every day as it get closer to expiry. That is theta. Then we have vega. Vega? Vega is another kind of Greek. Vega shows how option price change with volatility. So it shows how option price gets affected with volatility. Vega. Then gamma. Gamma is another kind of Greeks. They show how delta change. How delta change. And finally we have rho. Rho means they show sensitivity to interest rate. So basically, and what about option number D? Let's look at option D. It says that Greek refers to currency fluctuation affecting option. No, that is wrong. Because it has nothing to do with European market or European country. So let me give you one example to make it more clear. Let's say you are driving a car. So car is just your option trading. You can treat the car as option trading. You are driving a car. You want to know how fast you are going. So that is your delta. How fast you are going. That is your delta. You want to know how fast your speed is changing. Speed is changing. How fast is your speed changing? So that is your, that is your gamma. Okay. You want to know how much fuel you are burning per hour. So that is your theta. You want to know how the wind affect speed. So wind affecting speed, your vega. And you want to know how much a change in fuel price would affect your trip cost. So that is your rho. So basically, these delta, rho, vega, gamma, theta, these are like, Greeks. They don't drive the car, but tell you how your drive is reacting to different thing. So friends, let's summarize the fact. What we come to know from this particular discussion is that, Greek. If you talk about the Greek, just remember this point, that Greek are the risk indicator. In one word, I will say Greek are the risk indicator. Okay. And second point is that they help the option trader understand that how time, how price, how volatility, right, how interest rate, they impact their option value. What are the impact of this factor on option value? That is what you can understand with Greek. And the most common Greek are delta, rho, gamma, these are the most common Greek, and you know theta, vega, and it is useful for risk management. It is not a useful directive. So the next time someone say Greek in option, don't book a trip to Athens. Just think of risk tool for option trading. I hope that makes sense. Now friends, if you really think that this video is adding value to your preparation, please hit the like button. Next question is based on aggregate gap limit in spread. Have a look at it. So friends, question is, what does the aggregate gap limit in spread management primarily refers to? Option A, the maximum difference allowed between a bank asset and liability in a single currency over the day. Option B, the maximum cumulative mismatch in foreign currency position across all tenor, typically capped at a multiple of bank capital. Option C, a limit on the ratio of rate sensitive asset to rate sensitive liability in an interest rate gap analysis. Option D, the regulatory minimum liquidity ratio that bank must maintain based on demand deposit. So let's understand this using a simple scenario. Suppose a bank deal with foreign currency every day, right? Like suppose dollar, euro, and Japanese yen. These are the foreign currency. So basically they buy, they sell, they hold different currency over different time period. It time period may be 1 day, it may be 1 week, it may be 3 months. Okay. But what if the bank buy too much of a currency and does not sell enough? Yes. Suppose bank buy too much currency and does not sell it. What will happen? And or mismatch start building across different tenor. So that is where AGL, aggregate gap limit comes into picture. Basically what it does, it control the total currency mismatch. It control currency mismatch. AGL control the currency mismatch and the bank is allowed to take across all tenor. Let's see option number A. The maximum difference allowed between a bank asset and liability in a single currency over a day. So what do you think? Is it correct? It might sound okay, but it is too narrow. AGL is not just for 1 day. You can see over a day. No, it is not just for 1 day. Rather, it includes all the future period. It includes all the future period. I told 1 day, 1 week, 3 months, etc. etc. Option B say maximum cumulative mismatch in forex position across all tenor. So option A is wrong. Option B say yes. AGL tells the bank that you can't have a foreign exchange mismatch beyond a certain limit. That is what AGL tell. AGL, that aggregate gap limit, tell the bank that you can't have a foreign exchange mismatch beyond a certain limit. And if we talk about this limit is set at 6 times the bank capital. This limit is set at 6 times bank capital. So this AGL tells the bank that you can't have a foreign exchange mismatch beyond a certain limit. So suppose, let me give you one example to make this concept more clear. Suppose a bank has 1000 crore. A bank has 1000 crore in the capital. Suppose a bank has 1000 crore in the form of capital. So it cannot have FX mismatch. It cannot have FX mismatch beyond 6000 crore. That is the meaning of it. Okay. So that is what this FX mismatch tells you, that AGL tells the bank that you can't have a foreign exchange mismatch beyond a certain limit, and this limit is set at 6 times the bank capital. So suppose bank has 1000 crore in capital, so it cannot have foreign exchange mismatch larger than the 6000 crore. What about, yes, option B is perfectly correct. What about option C? A limit on the ratio of rate sensitive asset to rate sensitive liability in interest rate gap analysis. This is wrong. Basically that is the part of interest rate risk analysis, not FX gap. Here we are dealing with foreign exchange gap. What about option D? The regulatory minimum liquidity ratio that bank must maintain based on demand deposit. Again this is wrong, because this is about liquidity management, like SLR, CRR, not foreign exchange. Let me give you one example to make it more clear. So you can think of water tank, right? Water tank. So this is your FX portfolio. Your water tank is your FX portfolio. Okay. Now with multiple pipe. Suppose there are multiple pipes, and you can think of this pipe as time bucket. So this pipe are time bucket. So bringing in and taking out water. So the water you can think of like currency. So water tank, FX portfolio, foreign exchange portfolio, multiple pipes means time bucket, and water is currency. Now suppose more water comes in. Suppose more water comes in than goes out across multiple pipe. So tank of overflow. So that overflow is your foreign exchange mismatch. Suppose more water is coming in and less water is going out, and so what will happen? So obviously the tank will overflow, and that overflow is called foreign exchange mismatch. Okay, so this AGL, that is aggregate gap limit, is just like, you can think of this AGL as the height limit. You can think of them height limit. This height limit on how much extra water. Try to understand, very important and easy to understand example I am taking you. So this height limit is tell you how much extra water means mismatch, how much mismatch is allowed in total across all pipe, how much extra water is allowed. That is what AGL tells you. Okay, so what we learned from this discussion is that, let us summarize the fact. I told you that AGL is the total allowed currency mismatch. Just remember, total allowed currency mismatch, okay, in foreign exchange across all time bucket. And I told you it is capped by RBI at 6 times total capital. Remember, it is capped by RBI at 6 times total capital. This is the second point. And I told you this help in managing the foreign exchange risk. Foreign exchange risk management, it help in managing, right, over the time, not just daily. Remember, it is done over the time, not daily. And it is used in treasury to prevent excessive foreign exchange exposure. So remember, AGL is your foreign exchange risk boundary. If the bank cross this boundary, it is like playing cricket without boundary rope. High risk and no control. I hope that makes sense to you. I have explained each and every option in the lucid manner. Now friends, have a look at the next question. So before solving this ATM ITM, let us move to the next question, that is based on NDTL. Yes, first of all solve this question. So this question is based on calculating the NDTL. A bank has the following figure in crore: demand liability, time liability, other demand and time liability, liability to other asset with the banking system. What is this NDTL? So let's understand this step by step. First of all, what is this NDTL? Net demand and time liability. Basically, it tells us how much money the bank has taken in from the public. How much money the bank has taken from public plus public and other after removing what it hold with other banks. Removing it holding with other bank. Okay, so how much money the bank has taken from the public and other after removing what it hold with the other bank. It is very important number. Right, this NDTL is very important number, because using NDTL only you can calculate the CRR, you can calculate the SLR, you can calculate the liquidity as an LAF. So let's understand the step by step. What is the formula for NDTL? So NDTL, the demand liability plus time liability plus other liability and time liability plus liability to other, right, minus asset with the banking system. This is the formula for NDTL. So what is the demand liability? We have 1500. What is time liability? 3000. What is other demand and time liability? 500. What is liability to other? 1000. And what is the asset with the banking system? 700. If you calculate it, this will give you 6000 minus 700, or we can call it 5300 crore. Right? 5300 crore is the correct answer. Option number A is the correct answer. Right. So imagine, so let me give you one example to make it more clear. Suppose a bank is there. It collect 6000 crore in various deposit. It collects 6000 crore in all types of deposit, demand liability, time liability, other liability. But 700 crore is what? 700 crore is just lying with other bank. It is just lying with other bank, this 700 crore, not with the customer. So in reality, the bank net liability to the public is just only how much? 5300 crore, not 6000 crore. That is what NDTL shows, the true liability after removing internal banking asset. Okay, that is what that's why we subtract asset with the banking system. So what we learned from this discussion is that whenever you are asked to calculate NDTL, just remember all external liability, because these deposits are the kind of liability for the bank, because it has to pay interest on that. That's why it is liability. So you add all external liability and you subtract the asset with banking system. Then this will give you NDTL. And this is quite useful technique for calculating CRR, SLR, LAF, liquidity, etc. And bank on deposit with other bank are excluded. I told you. Suppose there is a bank deposit with other banks, they are excluded. And this concept is very much important in monetary policy and regulatory compliance. So remember, whenever you see this NDTL in a banking system, remember, it is what the bank owes to the outside world after removing its own money parked with the other bank. I hope you have mastered the concept of NDTL using this explanation. Now friends, let's switch our focus to the swaption. What is swaption? So, swaption, or question is which of the following statement about swaption is correct? Option A. Swaption is a standardized exchange traded derivative, or we call it ETD, contract similar to equity option. Option B. A payer swaption gives the holder the right to receive a fixed rate and pay a floating rate. Option C. A receiver swaption allows the buyer to pay a fixed rate and receive a floating rate. Option D. A swaption is an over-the-counter option that gives the buyer the right but not the obligation to enter into swap agreement. So friends, let's first understand what swaption is. So if we basically if we talk about the swaption, it is combination of two words, swap plus option, right? Swap plus option. It means basically what you are doing, you are buying an option. So why basically it is a combination of two words, swap and option. So let us understand what this swap and option is. So swap means you are buying an option. You are buying an option to enter into swap later. You will enter into swap later, right? And for that you are buying option. Is it clear? So you are buying option to enter into swap later, but only if you want to. There is no obligation. You have the right. You can enter into swap later. There is no obligation. You can think of it like booking a movie ticket with a cancel anytime option. Suppose you are booking a movie ticket and you have the option to cancel it anytime. Okay, so but you pay a little extra, that is the premium. Yes, you have paid a little extra, that is the premium. But if you don't want to watch the movie later, you are not forced to do. Similarly, with swaption, the buyer pay a premium to get the right, but not the obligation to enter into interest rate swap in the future. Because this is the characteristics of option. Option means you have the right but not the obligation. Okay, and you are paying for that a premium amount that you can enter into interest rate swap in the future, because basically swap means IRS swap. Now let's go through each and every option. I think I have provided you sufficient information to you can easily answer it. Option A say that swaption is a standardized ETD contract similar to equity option. No, this is wrong. They are not traded on a stock exchange. They are basically OTC. They are OTC, over the counter, which means can receive floating. So basically it is also wrong. Why it is wrong? Because receiver swaption gives the right to receive fixed and play floating. What about option D? Basically swaption is an OTC option. OTC option means it gives the right, not the obligation to enter a swap. This is the perfectly correct option. So basically if we talk about swaption, swaption it is just like privately agreed OTC option. Privately agreed OTC option to enter a swap. It is a privately agreed over the counter option to enter a swap. Okay, where the buyer has full control to say yes or no on the swap start date. So let us give you an example to make it more clear. Let's say you are a company expecting interest rate to rise in next 3 months. Okay, you are expecting that interest rate will rise in the next 3 months. You are not sure yet, but you want to be ready. So what you do? Okay, you are not sure, but you want to be ready. So what you do? You will buy a payer swaption. You will buy a payer swaption. What will happen? Means you are paying a small premium today. Obviously, premium has to be paid. You are paying a premium that gives you the right to lock in the fixed rate later. If the rate goes up, you will exercise the option and protect yourself. And if the rate stays low, you will let it expire, no pressure. Right? That is a swaption. So let's summarize key point about swaption. What we have learned? Swaption is the option to enter into swap later. Swaption is the option that we can enter into swap later. So what happened? That buyer pays premium for the flexibility. Premium has to be paid. It is a kind of OTC contract. It is a kind of OTC contract. They are not traded on exchange. And two types of swaption I told you. Payer swaption. Payer swaption means you pay fixed and you receive floating. You pay fixed and you receive floating. And the second kind of swaption is receiver swaption. So receiver swaption means you receive fixed and pay floating. Okay, so you can choose whether or not to enter the swap. So just remember, a swaption gives you the power to choose, not the obligation to act. It is a perfect tool for managing interest rate risk with flexibility. I hope that is clear to you. What is everything about swaption? Every aspect we have discussed regarding the swaption. Now, have a look at the next question. What best describe novation in the context of loan transfer? Novation, yes. So option A, it is a partial transfer of a loan where only the right, not obligation, are assigned to a third party. Option B, it refers to securitizing a loan by pooling it with other loan and issuing security. Option C, it involves the cancellation of the original agreement and substitution with the new one between the borrower and the new lender. Option D, it is a method by which the loan originator sells the loan without informing the borrower. So let's understand what novation means in very basic way. Basically, novation simply means, old agreement cancelled. Old agreement is cancelled and new agreement created. Old agreement cancelled, new one created between the borrower and lender. So old agreement cancelled, new created between borrower and the lender. So basically what happened, that the original lender step out of the deal completely and the new lender steps in with the borrower full knowledge and consent. It is like saying, hey borrower, I am not your lender anymore. Here is your new lender and you both will now sign a new agreement. So let's go through each and every option. Option A says that it is a partial transfer where only rights are assigned. What do you think about it? No, this is wrong. This is wrong. Why? Because this is a kind of assignment. This is a kind of, not novation, rather this is a kind of assignment, not novation. In assignment, what happened? The new party only get benefit. In assignment, the new party only get benefit, not responsibilities. Okay, that is, okay, so this is a kind of assignment, not novation. What about option B? This is another thing wrong, because this process is called, securitization. This is called securitization. That is completely different concept. It involves packaging loan and selling them as security. What about option C? Cancellation of the original agreement and signing new one. Yes, this is exactly right. This is what we call as novation. So basically what happened? The old is cancelled and the new is signed. Right? And the borrower agreed to this. This is what novation is all about. What about option D? Selling loan without informing borrower. So that may happen in the case of assignment. That may happen in the case of assignment, but not in novation. In novation, borrower consent is very much necessary. Okay, you can't, here is you can see the word without informing the borrower. This is completely wrong. You have to inform the borrower. Borrower consent is required. So let me give you one example to make it more clear. Imagine there is a bank A from which you took the loan. So from bank A you take the loan. After some time, this bank A want to exit and they want to introduce bank B, right, as your new lender. So bank A will cancel the old agreement and you now sign a fresh agreement with bank B with the same loan term or new one. So this is what we call novation. Okay. So this is a kind of clean handover with full agreement from all sides. So what we learned from this discussion is that, just let me summarize. Novation, whenever you see this word, this is a kind of new contract. This is a kind of new contract with new lender. We have a new contract with new lender. Okay. And original agreement is cancelled. Original agreement, what do we do? We cancel it. Okay. And what happened? Right plus obligation. Both right and obligation, they are transferred. Remember, right is also transferred, obligation is also transferred. And here, borrower consent is required. Borrower consent is needed. Okay. And it is opposite of assignment. This novation is, opposite of assignment. What happened in the case of assignment, where benefits are only transferred and original contract remain the same. So basically you can see that is a peculiarity of our session. We don't just discuss one question. We discuss multiple concepts related to that question, so that if any question appears in the upcoming examination, you can easily answer it. Right? And if you want such kind of video, such kind of PDF, you can enroll in our course. For more detail, you can WhatsApp me on this particular number. Now friends, look at the last question of today's session. Which of the following statement about forward rate agreement is correct? FRA is correct. Option A. And FRA is a stock trading contract executed on a stock exchange. FRA is a contract to buy or sell foreign exchange at future date at a fixed date. Option C, an FRA is the over-the-counter contract where parties agree today on an interest rate to be paid in the future. Option D, FRA allow party to exchange fixed interest payment for floating payment over the life of the loan. So these are the four options. Now let's understand what FRA in the simplest way possible. FRA is called forward rate agreement. It is like, it is like a deal that you make today, right, to lock in interest rate for a loan or deposit that start in the future. So basically what you do, you lock in the interest rate, right, for the loan or deposit that will start in the future. It's like saying, let's fix the interest rate now. I don't have to worry about the future changes. Now what is option A? So it is wrong. It is a stock trading contract executed on a stock exchange. This is wrong because FRA has nothing to do with, stock or exchange. It is an interest rate product. Remember, FRA is nothing, it has nothing to do with stock. It is a kind of interest rate product. Okay, what about option B? Is a contract to buy or sell foreign exchange at future date at fixed rate? No, this is forward FX contract, forward exchange contract, foreign exchange contract, right? Not a FRA. FRA deal with interest rate, not currency. Here the point is currency. Option C. It is an over-the-counter contract where party agree today on interest rate. Yes, this is the correct. It is a kind of private contract, OTC contract, where the two party agree today what the interest rate will be for a loan or deposit that start in the future, customizable one. Option C is the correct one. Option D, it allows party to exchange fixed interest payment. That is wrong. That describes the IRS, interest rate swap, not FRA. Let me give you a real world example. Imagine you are a company that need to borrow 10 crore rupees after 3 months. So you need to borrow 10 crore rupees after 3 months. Okay. You are worried that interest rate might goes up by then. So what you do to protect yourself, you enter into FRA today. So you enter into FRA today and fix the rate at 6% for that future borrowing. Now even if the actual market rate becomes 7%, what will happen? The FRA ensure that you effectively pay 6% only, saving your interest cost. So what we learned is that FRA, so let's summarize the key point which we have just discussed now about FRA. So first point is that FRA, FRA is a kind of OTC product. Okay, it fixed the future interest rate. It is used for hedging. And speculation. And underlying thing is the interest rate here. It is commonly used to lock a loan deposit rate in advance. Friends, we have several more questions available here as you can see. If you want me to explain all the remaining question, you can write yes in the comment section. I will understand that yes, you are interested in the remaining question. Now let's end our video with clear summarization of all the concepts which we have learned today. So the first concept I told you about, coupon. What is the coupon? Coupon means it is giving you fixed percentage on the face value. And this coupon yield is a kind of return. How do we find the coupon yield? What you will do? You will write coupon in the numerator. You write price that you have actually paid in the denominator and multiplied by 100 to get in percentage. So that will give you coupon yield. And remember, if you are buying larger than coupon, if your buying price is larger than the face value, your coupon yield will decrease. Okay, these are the 4 points which we have discussed. Now in the next question, what we discuss about front office, middle office and back office. I told you that this front office are the action. They are the deal maker. They trade, they manage the risk and manage liquidity. Middle office, you can think of them like monitoring. They are the controller. They report, they monitor and they maintain the risk. And then we have the back office. They are like administration. They execute, they confirm, they settle, they record. So remember, these are the key functions of these three office. Questions are most frequently asked. In the next question, we discuss about Greeks. I told you, Greek is a kind of risk indicator. There are several factors which determine the option value like time, price, volatility, interest rate. So all of these factors determine the option value. Delta, rho, gamma, theta, vega. These are, different kinds of Greeks. Then we talk about AGL, aggregate gap limit. So what does AGL show? AGL shows the total allowed currency mismatch. And RBI fixed the AGL at 6 times the total capital. And affects foreign exchange risk management over the time. It helps in foreign exchange risk management over the time. So remember, total allowed currency mismatch